Hi, this is Snider with Exencial Wealth Advisors. Hope you're doing well, and I wanted to share a few thoughts with you today about rising interest rates. So interest rates from the start of 2021 to where we are now in March, we've seen a pretty good move up in interest rates. Now, rates are still very low. We still have historically low interest rates, but we've gone from around 1% on a US 10-year Treasury yield to about 1.5%. And that certainly impacts what's happening in the broad stock market. It impacts the values for the bonds that we already own. And a number of my clients are asking what that means for their portfolios. Does that mean that we should sell the bonds that we own? Does it mean that we should go buy more bonds because interest rates are moving up? Does it mean something good or something bad for the stock market? So just to share a few quick highlights around how I might think about that. First off, the fact that interest rates are moving up is probably a positive thing for the US economy. That's probably a good sign. The economy is continuing to recover from the recession and the pullback that we had due to COVID-19. And we're continuing to see some relatively good economic news, come out here in the US and outside the US. We're also seeing good news on the vaccine rollout front that will hopefully lead us to being able to get back to some sense of normal. Being able to transact business in the way that we normally would for whatever normal is going to look like here in the future. So rates moving up is what you would expect to see in a recovering economy, in a growing economy. So that's probably a good sign. For the bond markets, whenever interest rates move up, remember our bond values will tend to fall a bit whenever we have rates move up. Now, if you owned those bonds in 2020, you probably saw the opposite happen. The bonds that you owned in 2020, their intrinsic value went up because interest rates fell. So we may see this year in 2021, we may give up some of that bond price appreciation that we got last year. We may give that up because rates are moving back up. When interest rates are as low as they are right now, what's really the base case for owning bonds? I think the case for owning bonds for most investors is more strategic right now than it is a pure investment argument. Because even with the rising rates that we've seen over the last few weeks, rates are still low, and the current yield on a bond is still the best indicator of what our future return on that bond is going to look like. So whenever we have very low rates, our future expected returns on bonds are still fairly muted. So with that said, why own bonds in the first place? We think that bonds do an important job in portfolios of providing some ballast, providing a little bit of balance against stocks, because those bonds are our preservation assets. They give us that sense of stability and safety in the portfolio. I think bonds are especially important for anyone who has income needs. If you're needing to make withdrawals from your portfolio, if you're using some of the investment assets that you've accumulated over the years for whatever purpose, for living expenses, to build a house, anything along those lines, having some bonds, some preservation assets in the portfolio gives you a place to access cash when you need it, particularly if we're having a bad time in the stock market. And since nobody knows the future, nobody knows when the stock market will have pullbacks, bonds are sort of that safety valve. On the other side, what does a rising interest rate environment mean for stocks? It means we've seen a little bit of a rotation in the stock market over the last few weeks. We've seen some areas of the stock market that were doing well, kind of hit the pause button a little bit, particularly on some of the more expensive parts of the market, some parts of the market that might be seen as a little bit more speculative in their nature. And we've seen some other parts of the market that had been sort of in the doldrums for a bit have really come to life. So over the last several weeks and months, small caps have outperformed, value companies have outperformed, cyclical stocks have done well. And then, the more growth parts of the market, the technology sectors in the market have kind of taken a back seat. This is a great picture of why diversification is important. We don't think it's really in your best interest to have all your eggs in the growth basket or all your eggs in the value basket. We don't think it makes sense to load up too much on high risk assets. By the same token, we don't think it makes sense to just be way too defensive in your portfolio. If you have a good balance and a good diversified approach to your stock holdings, then you're always in a position to be capitalizing on what's doing well in the market. So hopefully that's helpful for you today in thinking about rising interest rates. Our team is always happy to be a sounding board for you if you're thinking through how rising rates or how any other issue is impacting your portfolio and your investments. So don't hesitate to reach out to us. Thanks. Have a great day.